So thank you, Michael. It's really a pleasure to be in Fayetteville. Thank you to the local sponsors for hosting us. I'm going to talk today a little bit about the national economy and then turn to the 10th Federal Reserve District economic outlook. The 10th Federal Reserve District is headquartered in Kansas City with offices in Denver, Omaha, and Oklahoma City. But first, I want to talk about how the U.S. economy is doing, and frankly, it's doing pretty well. From the perspective of the Federal Reserve's dual mandate for maximum employment and price stability, we're pretty much there. The unemployment rate is 4.1%. That's at or probably below most estimates of the full employment unemployment rate. And inflation has been low and stable. It is coming in a little bit below our target of 2% for the personal consumption expenditure price index, but it's not that far below 2%. And today I kind of want to focus my attention on that deviation of inflation from target. It is complicating monetary policy because normally when inflation is below target, we would want to be providing accommodation so that inflation would move gradually back up toward target. But at the same time, the other leg of our dual mandate, employment, is falling below the full employment unemployment rate, which would normally call for delaying further accommodation and reducing the amount of monetary accommodation in the economy. So I'm calling this presentation the inflation deviation. I was tempted to call it the Great Inflation Deviation, the Great Depression, the Great Moderation, the Great Recession, now the Great Inflation Deviation. But I think that's really an exaggeration because I don't think it is a great deviation. I think it's a small deviation. And it's one that we focus on because we have this numerical objective for inflation of 2%, and people expect us to hit that target consistently, and that's just not realistic. I think we can expect deviations from that 2% target and sometimes persistent deviations from that target. So my theme today is that inflation is in fact running below our objective, but this low inflation doesn't appear to be related to cyclical weakness. And finally, I think we can expect inflation to remain stable and to rise over time toward 2%, providing inflation expectations do not become unanchored. So what is the inflation objective? It's laid out in the Federal Reserve Reform Act of 1977, which says that the Federal Open Market Committee, the Federal Reserve, should promote maximum employment, stable prices, and moderate long-term interest rates. In the past, this mandate has been interpreted in qualitative terms. So, for example, past chairmen Volcker and Greenspan used to talk about price stability as a state in which expectations of inflation are not a pervasive influence on economic and financial behavior. But in the wake of the Great Recession, the financial crisis, the Federal Open Market Committee decided to quantify that definition of price stability. And what they agreed to was that they would consider price stability as an inflation rate of 2% as measured by the annual change in the price index for personal consumption expenditures, and that would be most consistent with the longer run, in the longer run, with the Federal Reserve statutory mandate. So what does inflation look like relative to that 2% target? Well, ever since we announced the 2% numerical objective, inflation has pretty much run below 2%. Since the financial crisis, inflation has been pretty steady, but in a range of 1 to 2%. And more recently, at the end of last year, inflation was moving up nicely toward 2%. In fact, fourth quarter last year, inflation reached, core inflation reached 1.9%. And then since February of this year, we've seen a deterioration in that inflation rate. And right now, the core inflation rate is 1.3%, which is raising concern among some people that the Fed is not achieving its mandate for inflation. So there's a wide range of explanations and factors that go into influencing the inflation rate over time. And I want to go through these factors and talk about how they are causing weakness in inflation, or how they are suggesting that inflation should in fact be rising instead of coming in on the soft side of 2%. So these factors are first inflation expectations. They are important because if people expect inflation of 2%, say, they build that 2% inflation rate into wage contracts, into prices that they're charging and so forth. And so the expectation of inflation of 2% becomes the reality of inflation of 2%. And as long as inflation expectations are well anchored, inflation is going to tend to stay steady at whatever rate inflation expectations are anchored at. Fortunately, right now, inflation expectations are pretty well anchored near 2%, or a little bit below 2%. And the key here is to make sure that we don't see those inflation expectations slipping further and further below 2%. They don't appear to be doing so right now, and in fact, inflation expectations should be holding up the inflation rate and preventing a further softening in inflation. A second key factor in determining inflation is economic slack. One of the surprising things about this expansion is that as we went from an unemployment rate of 10% now down to 4.1%, inflation has been remarkably steady. An unemployment rate of 10% you might think would cause inflation to fall. It might even lead to a deflationary period. That has not happened, and it's not happened largely because inflation expectations have been well anchored. At the same time, the relationship between inflation and economic slack has weakened considerably. We have seen the unemployment rate come down to 4.1%, but very little upward pressure on inflation emanating from that. A third factor, of course, is food and energy prices. The collapse of energy prices after June of 2014 led to considerable downward pressure on headline inflation, and that in turn was transmitted through to core inflation. That has been a major headwind to inflation throughout the period since 2014. A fourth factor is import prices and the exchange value of the dollar. We also saw an appreciation of the dollar in 2014, which was another headwind for inflation, keeping inflation lower than you might otherwise have expected. That headwind has begun to subside, as has the headwind from energy prices. And then finally, there are idiosyncratic movements in relative prices, and these movements can be structural or purely idiosyncratic. An example of that is the introduction of unlimited data plans in cellular contracts, which led to a huge drop in telecommunication services prices, and that in fact had an effect on inflation of probably 0.1%, holding it down. But that's idiosyncratic. It's going to go away. It's not a fundamental factor affecting inflation. So I'm going to go through each of those factors and just show you some data and how the economy is dealing with these issues. The first chart here is inflation expectations, and my point is that they have been relatively stable. I've got three indicators here. I've got the University of Michigan's survey of consumers' inflation expectations. That's the blue line. I have the survey of professional forecasters, 10-year ahead inflation forecast. These are a panel of economists who are forecasting the economy and asked, what is your expectation for inflation in 10 years? That's been very stable at around 2%. And then finally, a market-based measure, the break-even inflation rate, the five-year forward break-even inflation rate. And we have seen some deterioration in that below 2%. But I think the point here is that there has been some downward movement in some of these indicators, but they've been relatively stable, and they're continuing to anchor inflation around the target of 2%. The second factor was economic slack, and here I've got two measures of economic slack. The green line here is the unemployment gap. It's the difference between the actual unemployment rate and the Congressional Budget Office's estimate of the natural rate of unemployment. And you can see that that's now dipped below the zero line here, indicating that we've gone from a situation of labor market slack to a situation of labor market tightness, which you would expect to begin exerting upward pressure on wages and eventually upward pressure on inflation. And then finally, the blue line here is the output gap, which again is the actual level of real GDP relative to the Congressional Budget Office's estimate of the natural rate of GDP. It too has shown that slack in the product side of the economy has also disappeared. The third factor I talked about was, still on economic slack, the expectation would be that with a tightening labor market, we begin to see wages move higher, a higher rate of wage inflation. That has not occurred to the extent that we might normally think. And again, that's because this relationship between slack and inflation seems to have diminished in recent years. But I mean, you have seen a little bit of an upward movement in wages from, you know, the 2% annual rate of increase from a couple of years ago to now around 2.5%. But you know, the expectation would be that if labor markets continue to tighten, we would begin to see this wage inflation measure, these two measures move up. There are two measures shown here. One is the employment cost index, the other is average hourly earnings. Okay, the other factor, I guess it's the third or fourth factor at this point, is energy prices. And as I said, energy prices were a big drag on inflation in 2014, but they have since recovered to some extent, and that headwind should be fading. Similarly for food prices are still a drag on overall inflation. Commodity prices have declined sharply, and that's been passed on to food consumed at home, and that continues to be somewhat of a drag on inflation. Import prices, again, were a drag on inflation in 2014 and 2015, but we've seen that headwind turn into a tailwind as the dollar has now started to depreciate. And here's kind of a summary breakdown of how important each of these factors has been. The yellow bars show the level of inflation expectations that has helped hold up the inflation rate. The inflation rate is indicated by the black line. And the inflation rate here is being decomposed into the various factors that are influencing inflation. So the yellow bars are a primary factor holding up the inflation rate. And you can see that in the past, a lot of the movement in the overall inflation rate could actually be explained by relative food and energy prices, the blue bars, which are below the horizontal axis, indicating they're holding down the inflation rate. They're explained by the green bars, which is economic slack. There was considerable economic slack over the period 2008 to 2012 that held inflation down. That slack has now disappeared. And the green bars actually moved from below the horizontal axis to above, indicating that it is now a small upward factor, causing some upward pressure on inflation. But the thing to note here is that in the most recent period, in 2017 year to date, the factors that are holding down inflation, the orange bar, are the other factors, the idiosyncratic relative price changes. And there are a combination of things that are very temporary in nature and a few things that are more structural and perhaps persistent. What types of things are they? Well, on the idiosyncratic temporary side, there are things like the cellular data plans, which I mentioned. In addition, there were some prescription drugs which went off patent and caused a decline in prices for pharmaceuticals for a month or two. But there are also some structural and longer-term factors that are contributing to the softness that we're seeing in inflation. They include what I've called the Amazon effect, the disruption that's going on in retail markets, Amazon's purchase of Whole Foods, the entry of Aldi into the US grocery market, and so forth. There's technological change, which is allowing huge improvements in our online experience and applications of that to business models, global competition. And finally, there's a lot going on in healthcare, and healthcare is a large component of the personal consumption expenditure price index. It's one of the largest. And the moderation of healthcare prices has had a longer-term effect on overall inflation. This shows that a lot of the moderation is coming from the services side, which has, since February of this year, has come down from 3% to 2%. Goods prices have been a persistent deflationary influence on the economy. The slowdown in services that we've seen has been pretty broad-based. It's not just in one sector, but you can see it in healthcare a little bit. Healthcare has been running below 2%. This shows what it was last year and what it is this year, year to date. There's a big decline in financial services and insurance. That's a small component of the personal consumption expenditure basket. Other, that includes the telecommunications sector, but also housing and utilities. Focusing in on healthcare, there's the trend in the healthcare component of the personal consumption expenditure price index, and that has been a persistent headwind against inflation. We're seeing that maybe moving up again, but this is kind of a longer-term issue, and does not appear to be diminishing. But a lot is going on, as you know, in the healthcare sector, so who knows what will happen here in the future. One of the factors that is behind the moderation in healthcare services prices is Medicare and Medicaid payments that have been reduced administratively. But all of these factors, are going to be moderating as we go forward, and we think the fundamentals are going to be reasserting themselves. So economic slack, the elimination of slack, the tightening of labor markets, the unwinding of these temporary idiosyncratic relative price changes, the depreciation of the dollar, the diminishing of headwinds from energy prices and food prices, all of that is expected to unwind. Here I'm showing the Federal Open Market Committee's summary of economic projections, the median from their September projections. And as of September, the median projection was still for inflation to rise gradually over this forecast period to 2% by 2019. So to summarize here, I think there are good reasons to think that inflation is going to be rising and heading back toward 2%. First, labor markets are tight and are expected to tighten further. The headwinds from past energy price declines and the appreciation of the dollar have faded and perhaps are turning into tailwinds. Some of the one-off relative price declines that we saw earlier this year are going to eventually roll out of the 12-month window over which a 12-month inflation rate is calculated. We are seeing increased demand for healthcare services, partly due to the Affordable Care Act. Eventually, those demand pressures may start to be shown through to healthcare services prices. And finally, monetary policy remains accommodative. as I said, we're meeting essentially our dual mandate right now, and yet our target federal funds rate is still a considerable distance from the longer run nominal federal funds rate that the committee thinks will prevail in the long run. So the gradual removal of accommodation that the FOMC is contemplating should maintain accommodation over time, and that will also contribute to some upward push on inflation. All right, let me turn quickly to the 10th Federal Reserve District. And that's another slide deck. Excuse me. I'm going to go through this quickly because I think I know more about the national economy than I do about the 10th District economy, which is why I'm looking forward to hearing the discussion about the regional economic conditions. So the 10th District is a 7-state district. It's the eastern third of Missouri, Kansas, Nebraska, Oklahoma, Colorado, Wyoming, and the northern half of New Mexico. So it's a large geographic area. And the performance of the district economy has varied depending on how heavily a state depends on energy and agriculture, because those two sectors have not been doing very well, although they're beginning to recover. So the district has been growing slower than the nation. It has improved this year after 2 very difficult years in 2015 and 2016. The unemployment rates in the district states have begun to decline again, and that's contributing to rising wage pressures. We did see a strong rebound in oil and gas activity that helped in the first half of this year, but energy activity was slowing before the hurricane, so we expect less of a boost from the energy sector than we got in the first half of 2017. Here's a map of the district that shows employment growth as of September across the district, and here you can see the dichotomy between the energy-dependent states, ag-dependent states, and the more diversified economies. So in particular, Wyoming and Kansas, and to a lesser extent, Oklahoma have been growing employment at a slower rate than the nation as a whole. All of those states were hit by a combination of lower energy prices and lower commodity prices, which has slowed employment growth. New Mexico is another area where growth has lagged the United States. New Mexico is heavily dependent on federal contracts and federal spending to those to the labs in Los Alamos and in New Mexico have contributed to a sluggish economy there. In Kansas, not only has the ag situation contributed to some slowing of activity, but also the state financial condition has deteriorated, and state spending has been cut sharply. State taxes were cut under the Brownback administration. Now they're being raised again, and Kansas is having a tough time. So despite the slower pace of employment growth, the unemployment rates across the district are low relative to the national unemployment rate. You see in Colorado and Nebraska, very low unemployment rates. These states typically have a low structural unemployment rate, and they are reaching new all-time lows. Higher unemployment rates in, again, the energy producing states, and in Missouri, something more close to what the nation looks like. Here I show the district unemployment rate, which has started coming down again, and the resulting upward pressure on wages. Wage growth in the district had been very sluggish through the fall of 2016, And recently, we've seen a rather dramatic pickup in wage growth, and that's apparent in our services wage pressure index, which is shown by the orange line, and 10th District average hourly earnings growth, which is from the BLS. A marked increase in both of those indicators. Employment growth in the district is coming from natural resources and mining, which is still a small share of total employment. It's coming from professional and business services, education and health services. We're seeing weakness in state and local government spending, or state and local government employment, and in the information sector. Again, that's the telecoms that are reducing employment, consolidating and reducing employment. These are our manufacturing indexes, which were held down in 2015 and 2016 by the appreciation of the dollar and by the decline in energy prices. They are now bouncing back and at very healthy levels. This shows capital expenditures in the district. Again, they're bouncing back after a period of weakness, particularly in the energy sector and in services. Manufacturing is coming back. Ag remains weak. I'm not going to talk about this chart. Minet, I think, is going to talk about energy, but the stability of energy prices since the beginning of this year has helped to bring back a little bit more drilling activity in the district, which I'm showing on this chart. The rig count at the nation and in the district has gone up. The effective rig count has gone up further than the actual rig count because of tremendous productivity gains in the production of any given rig. The horizontal drilling and fracturing technology has improved tremendously so that a lot more oil can come out of any given rig. Impact of the hurricanes, again, Minet is going to talk about this, but our surveys indicate that they've had little impact. When asked what type of impact is your firm experiencing from the hurricanes, the majority of respondents said no impact. And the second largest segment said a moderate negative impact. And the sense of our survey participants is that the duration of the impact of the hurricanes on these various parts of the energy sector is going to be relatively short. These are commodity prices that are relevant for our district in the ag sector, and they continue to show considerable weakness. That weakness is reflected in farm income, which is down, and it's also been reflected in farmland values. We had a tremendous boom in farmland values in the early 2010s, 2011, 2012, and that boom has turned into a modest downturn in land values. So to summarize the district economy, the labor market continues to tighten. The district growth as a whole is a little bit slower than the nation's. We've had a strong rebound in oil and gas in the first half of 2017. That's moderating now in the second half of 2017. And we expect to see lower levels of ag prices, at least in the near term, which will continue to be a drag on the agricultural sector. So with that, I'm going to stop and turn it over to Minet. Thank you very much.
All right, good morning, everybody. George is a lot taller than I am, so I need to bring this down a little. So what I'm going to do is briefly discuss the long-term factors behind Texas's growth, and then give you an update on the current state of the economy, and then also a brief update on Hurricane Harvey and Nate's impacts. All right. All right, so, and that's what I said. So this table highlights the persistent long-term growth of Texas and the strength of the economy in the past four and a half decades. With the exception of the 80s, when we had the first oil bust, Texas has been in the top 10 in terms of employment growth and GDP growth. Now, more recently, that's the bottom in the 2010s, since the Great Recession, we've really, that relative growth has really hit a high mark in Texas, but you just have to remember that that includes the oil boom. So we had a huge, we had very high growth during the boom. Okay, so the Fraser Institute calculates an economic freedom index that includes indicators such as size of government, taxation or tax burden, regulations, and including business and labor market restrictions. And the most recent index that I have here is from 2014, and that ranks Texas fourth highest in terms of economic freedom. I should note that there's a flip side to this, of course, to the size of government and taxation and so on, and that is state services. So Texas has always been a low tax, low regulation state, but it has also been a very low state services state, or a low service state, and usually in the bottom of state services. And so what that does, it does affect education and health outcomes for the state. So that low tax and low regulation environment, though, contributes to a historically stronger growth in new firm formation in Texas. So what you see here is the growth in new establishments in Texas through several decades, and you see that that increase is quite a bit higher in Texas versus the rest of the nation. And again, in 2010s, or let's see, 2010, 2016, that really increase, but again, you have to remember that that's the oil boom years for us. Texas has made important strides in K through 12 education outcomes over the past several decades, but we still have a long ways to go. What you see here, the top is the data from the National Assessment of Educational Progress, and that shows that Texas is 22nd in terms of 8th grade math scores. And that's one of the measures they look at. And this is actually an improvement from what we had in the 1990s and early 2000s, because we were in the bottom half of the states in those days. However, if you look at some other measures, and I've listed them there, and I'm not going to go into too much detail about them, and I can give you more information if you need it later, we are sort of at the very bottom of educational outcome. And these are a little bit more general indicators than just 8th grade math scores. Historically, Texas has been a very affordable state. For example, a worker that moves from Silicon Valley to Austin, and we've seen a lot of those happen in the 90s especially, still going on a little bit, with the same salary could afford a much larger house at a much lower price. So this is the National Association of Home Builders Housing Opportunity Index, so it's sort of an affordability index, and that's the share of homes sold in an area that are affordable to a median income household. And you can see by that measure, Texas actually is a lot more affordable than a lot of the major cities, but the ones on the bottom are the least affordable cities. So it's sort of not a maybe an unfair comparison, but still it's very affordable compared to these large metros. The one thing that you should note, though, going from 2005 to 2017, Texas has become less affordable, especially in Dallas and Austin, which are really growing very fast. So one caveat here is that if housing costs keep escalating at a rapid pace, then this is going to sort of narrow our competitive edge with the nation and other cities. Okay, and here you see population growth. So positive growth factors in Texas have led to a much faster population growth in the state, and this gap has really increased between the nation and between Texas and the US significantly over the past 3 decades. So the median age in Texas is 34, nation is 37. We have a higher rate of household formation in Texas, so you get more, population growth. It's, what is it called? Natural increase. So you can, those are the dark bars for US and Texas, but we also have a lot of immigration. Because the economy is doing well, we have a lot of immigration from other states, and we have also immigration from other countries, but you can see that immigration has actually, the rate of growth has, or the number of people has come down a little bit. Even though there's still quite a bit, you can see that bar, the light blue bar is a bit smaller. Okay, so now I'm going to turn to how Texas is doing in the most recent year, 2017, what we're doing. So Texas, we grew moderately this year, and weaker growth in 2015 and 2016. So what changed? Through August, we grew about, through September, we grew about 2.2% and added about 200,000 jobs. So what changed this year versus 2015, 2016? Well, one is that the manufacturing sector, which had been losing jobs in 2015, 2016, actually started adding jobs this year. And then the energy sector, which lost a total of about 100,000 jobs in 2015, 2016, also started adding jobs this year. Hurricane Harvey did deliver a negative shock to Texas, but we expect the economy to recover from that and actually come back to where we think it was going to be before Harvey. So 2.5% growth is the current forecast, so our forecast has not really changed with Harvey. So here you see Texas and US job growth. These are year-over-year growth rates, and Texas is blue, US is red, and you can see that we grow faster than the US on average. And that was the case until we got to the oil bust. So you see in 2015, we grew less than the US, 1.3 versus 1.9. And then 2016, 1.2 versus 1.6. But as I said, this year we've accelerated. So 2.2 versus 1.3 for the nation for this year. Now, one pattern that we saw in 2015, 2016 was that the goods sector was really weak and lost jobs. And so the goods sector, as you may remember, is construction, oil and gas, and manufacturing. And you can see the goods sector, those are the negative, the red lines there. And then in 2017, we started, as I said, adding jobs in manufacturing. The reason, part of the reason for that is the oil prices sort of stabilized between $45 and $55 this year. That helped the oil industry, so oil and gas industry started adding jobs. Then the manufacturing industry that is tied to the energy sector also started adding jobs. And one other factor is, and George mentioned this too, the dollar has started falling at the beginning of 2017, and so that also helped our export sector. Now, dollar has moved up a little bit in recent weeks, but still, overall, it was weaker than the years before, so that led to increased exports. So the goods sector stabilized and added jobs this year. Now, here you see the main sectors. So where is this growth? Which sectors? So I have two things here. One is year-to-date through September, and also September, so you can sort of see the effects of Harvey here. So these bars are ranked in terms of the sector's importance in employment in Texas. So the largest is trade, transportation, utilities, all the way down to the smallest, which is oil and gas. And you can see that with Harvey, those are the red lines, that's September. Leisure and hospitality lost about 15% of jobs. And this is because people were sitting in their houses, couldn't get out of their houses, and restaurants were closed, small businesses were closed, so you see professional business services also lost some jobs in September. Now overall, I forgot to say this, and I'll show this later, we had a forecast about 40 to 60,000 jobs lost in September from Hurricane Harvey. When the numbers came in, it was 4,400. So while this is great news, we think that it's going to change when we get the November numbers when is it? I think at the end of next week, because usually the revision will come for the September number, and they will be revised down. This usually happens with hurricanes. But if it stays at 44, we'll be very happy. Our model won't be so happy, but we will be happy. Then what else is here? So as I said, oil and gas sector added jobs this year, so you see the positive this year and also in September added jobs. And then the construction sector wasn't doing that well, but you see in September actually 5.7% job growth in construction, and that's because people started rebuilding after the hurricane, and we expect this sector to be pretty strong this year and the next if they can find the people to put to work. Okay, so one thing about Texas is we were very oil dependent. We've diversified our economy after the first oil bust. But the oil and gas sector has come to prominence again as the shale boom, with the shale boom. And oil prices do play a major role in the Texas economy. So what you see here is the oil price, which is in blue, and then the red is the differential between Texas and the US employment growth rates. So since 1970, we generally grow about 1% faster than the nation. And when oil prices are high, that difference grows, and when they're low, or if that growth or that difference relative growth rate diminishes or narrows. So what you're seeing here, I don't know, does this have a? Oh, okay. So here in the 70s, you see that we were growing a lot faster than the U.S. Our relative growth was quite high, much faster, much greater than the 1% average. And then afterwards, as oil prices fell, we went into bust. That sort of became more normal. Now, after 2008 and with the shale boom, you see that it has come back up slightly right here. But then with the bust in 2014 of oil prices, you see that our relative strength has actually become, we're growing a lot less than, or as I showed you earlier, smaller growth than the nation after the oil bust. Now, let me say a couple of words about energy. We are the #1 producer of oil and gas in the nation, and Texas is one of 8 states that is actually helped by higher oil prices. The downstream sector is actually very important as well. Texas has about 30% of all refinery capacity in the nation and about 60% of all U.S. petrochemical capacity. And much of this product is exported in terms of gas, gasoline, diesel, and petrochemical products. Now, looking at the Texas oil industry, what we're doing right now, so you see that output is the blue and the red is the rig count. This is Texas. And so here's the huge decline in the rig count with the drop in oil prices. Then it started sort of coming back up in May of 2016. But with that decline in the rig count, you see that output started declining as well. But again, as I said, as prices stabilized, you see output coming back up. So here, this is August, and Texas production fell in August. It's about, let's see, that's not, the 374 is the, hold on, let me look at the number. It was 3.4 million barrels per day in August, but we have also some estimates, weekly estimates. And the weekly estimates put Texas output at 3.73 million barrels per day. That's from the Department of Energy. So that tells you that the Department of Energy is thinking that output is actually going to come back up. But these weekly estimates are really noisy and not too reliable. So, but again, 3.4 or 3.7, that's a lot of oil coming out of Texas. Excuse me, a lot higher than a lot of oil-producing countries. The rig count had started back up, but you see here that it actually started falling again, and so it's about 441. That was the end of October. But anyway, okay, so let me go just a couple of other industries. Oh, sorry, one more thing about Texas. I mean, energy. So we do a survey, energy survey. We survey about 200 oil and gas firms, and on a quarterly basis, and this is our business activity index from that survey. So it's a diffusion index, which means, and you see the components there, the percent that says increase is the green, percent that says decline is the red, and the index itself is the line up there. And you see that the index has been actually falling all through 2017, and it fell appreciably in the third quarter, but it doesn't mean, it's still not negative, it's positive. So that means that business activity is still positive, but it's growing at a declining rate. So it's sort of, the growth is slowing, but it's still quite positive. Okay, so let me go and, oh, all right, one more. So this is the company outlook index, and oil people are always very positive. You can't be in the oil business and not have a positive outlook, I think. So what you see here is actually, this is the outlook. So even though activity declined, I mean, activity did not decline, but the rate of growth of activity declined, our survey participants were pretty optimistic, and they're seeing their outlook is actually improving, more rosy outlook. And I think part of it is probably due to the fact that OPEC said, well, you know, we're going to keep these cuts until the end of 2018. And everybody thought, okay, well, maybe we won't get a huge decline in prices again. But they are optimistic. Okay, now I can go to housing. So this is new indicators of new home construction in Texas. And very briefly, you see that multifamily, which is the blue, has actually declined quite a bit. It's basically at the same level that it was last year. And some of the reasons for the weakness are that there's a lot of product on the market, and banks were less willing to lend for new apartments. And part of it is also they can't find people to work in the construction industry. Now, and Houston really pulled back after the energy bust, so a lot of this decline is coming from Houston. For single-family permits, you see that they were going up, but they've also declined in that latest number there. And this is partly a result of higher home prices, but also a lack of labor for construction. And then the residential housing starts, that's multifamily and single-family together. That's coming down, but that's really more a function of the multifamily rather than single family. Now, one other thing, I don't have a picture for that, but the existing home market is still pretty tight in Texas. Texas house prices were up about 6.3% year over year in September, and also the months of inventory are about 3.8 months of inventory, so it's still a pretty tight market for the existing home market. The banking sector is in good shape. What time is it? Okay. So what you see here are non-current loans, and all are trending down. The one that had gone up, the green line, is C&I loans, so that includes energy loans, and those were actually going up and were non-current. But you see that has started to come down also, so that's, it came down, started coming down in the third quarter of 2016. So that is a good sign. And then here's a different way of looking at the same data, different cut here. So this is district now, not Texas. So Texas district is about 99% Texas. We have a very small portion of Louisiana, northern Louisiana, and a portion of southern New Mexico. But in terms of activity, it's basically Texas. So this does include, though, Louisiana and our portions of Louisiana and New Mexico. So what you see here are, again, those non-current loans, and what you see is that the CNI, which is the blue here, is the biggest percentage of non-current loans still. That's about 41% of non-current loans in the district. And then after that comes residential real estate, which is the red, and that's about 25%, and then commercial real estate, which is the green, it's about 17%. That's really different from the nation, because you see for the nation, the biggest non-current share is residential real estate, and that's about more than 50%, about 56%. Okay, and I think I'll just not talk about this, but you can see the fastest growing section or sector of loan demand is in commercial real estate, both for the nation and for Texas. And in Texas, loan demand is a little bit higher than the nation. Okay, so let me talk a little bit about Hurricane Harvey. Hurricane Harvey caused widespread damage in Houston and in southeast Texas. But we think, and we're seeing that it has negative but transitory effects on employment, on the energy sector, exports, retail sales. So although I say this is transitory, there was a severe damage to housing, to property, and to infrastructure. And so the initial loss estimates for Harvey are actually quite high, higher than for Hurricane Sandy. And the recovery and the reconstruction is going to boost Texas growth, but it's also going to increase wage inflation in the coming months, we think. Texas's unemployment rate is 4%. That's the lowest we've had since 2000. So in a market where labor is tight, both in the nation and in Texas, you're going to see further labor shortages and wage inflation. But again, as I said, we don't think it's going to change. It's not going to change our growth forecast for this year. So here are the Harvey costs that they've declined slightly. It used to be going from 75 to 106 billion or so, but still you see that it's going to be quite costly, not as much as Hurricane Katrina, but more than Sandy. And the losses from the hurricane come in two forms, direct and indirect. Direct are loss of personal and commercial property, public-private infrastructure, and so on. And what you're seeing here is mostly direct, but there is some indirect, which is the time losses, which is loss of restaurant meals and hotel stays and so on. So the employment loss, as I said, we ran, our regional group ran a couple of models to estimate what the forecast, what the impact of the hurricane was going to be on employment, and the numbers they came up with were 40 to 60,000 jobs lost. And these were dependent on past hurricanes, this, that. But then as I showed you earlier, the numbers that came in was 4,400. So that's a great number, but as I said, we think when the revised numbers come in this month, that's going to be a little bit higher. But then for October, we were saying, well, you know, it's going to be a rebound, basically, and then November and December are just going to be the same as before. So, and this is the picture that sort of shows you that there's going to be a decline and then come back up and stay above at trend, but the level will be a little bit higher for a while. Okay, and then what about energy sector impact? So Harvey we shut in both oil and gas production in the Gulf of Mexico, about 20% for each during Harvey, but the refineries, all refineries, 14 refineries were shut down. Now all of them are open, with one operating at reduced rates and one is just restarting. 80% of the ethylene capacity, so the petrochemicals, was shut down during Harvey. I have here 15%, but I was just talking to somebody from the chemical industry and they said they're basically back to pre-Harvey levels. And then we had all ports shut down, but now every port is open with only one with restrictions. And then the damage to homes, this is from CBRE, about 72,000 single-family homes and 11,000 multifamily were severely damaged. And then for autos, the number that I have is about 300,000 autos were damaged. And so reconstruction is going to lead to, we think, labor shortages and wage increases. Now, we did have one other hurricane, and that was Nate. I'm not talking about Irma because that didn't really affect us too much, but here's Nate. Nate affected not not the refineries or the petrochemicals, but oil and gas production in the Gulf. And you can see that about 93% of all oil production in the Gulf was shut down because of Nate, and about 78% of natural gas production was shut down. Some of it, most of it is back, but still you have about 20% shut down in oil shut down in the Gulf, and about 12% of the natural gas production still shut down in the Gulf. This is as of the middle of October, though, so maybe some of those have come back also. Okay, only 2 refineries were impacted. One is back. I haven't really seen much updates on that. All right, so I'll just finish up by saying Texas has been in the top 10 of states in terms of long-term output and job growth. Factors such as the low cost of living, doing business, has attracted firms and people into Texas. Swings in oil prices still affect the Texas economy quite a bit, but we've weathered the oil bust and we grew moderately this year. Energy and manufacturing have made a comeback. $50 oil, though, is sort of leaves our producers on a knife's edge. $50 is not good for everybody. It's good for people who are in the best areas and who have the, everybody has the same technology, but it's not everybody can make money with $50. So people are waiting to see 55, 60, they say if it's 60, we're all good, but if it's 45 or 40, then that's not good. So 50, if it's stable at 50, you'll see activity still continuing, but maybe at a reduced rate. So Harvey caused serious damage, but we didn't really change our growth forecast. It's temporary. The risks to Texas on the downside are low oil prices, as always, and then labor shortages now. And the upside is strong growth in both the nation and the international economy. So I think barring any unexpected, shocks, we will grow pretty well. 2.5% is what we'll end up with this year, and we think 2018 is going to be a good year as well. So I will leave you with that. Thank you.